Hello, my name is Joseph Gabelli and I'm a portfolio manager on several strategies here at GAMCO Investors. I also cover the global beverage industry for the firm and wanted to provide an update today about Diageo. Diageo, which is an $80 billion market cap company based in London, is the largest global producer of premium spirits and owns a portfolio of well-known brands including Johnnie Walker Scotch, Don Julio and Casamigos Tequila, Crown Royal Canadian Whiskey, and Guinness Beer, among many others. The company sells its products globally, with the business anchored by the North American market, which accounts for over $8 billion of its $20 billion of revenue and more than half of its $6.5 billion of EBITDA. Diageo surprised the market this past week by lowering both their current year and medium-term outlook, in part due to unexpected weakness in their Latin American business. The announcement was particularly surprising given that it came right before a major investor event held in New York at the company's offices, the first for recently appointed CEO Deborah Crew. We attended the event and thought it would be a good time to provide an update on the company, its prospects, and highlight that we think that Diageo's current trading price represents an attractive entry point for investors looking to own a high-quality, globally scaled consumer staples company. Taking a step back, the global market for alcoholic beverages is approaching $1 trillion. It's a market that has grown about 4% annually and is expected to continue growing at around that rate, driven by a growing number of legal drinking age consumers around the world that are becoming increasingly affluent. Spirits, the market which Diageo competes, represents a little more than $200 billion of that spend, and it's growing faster than the overall market. It's an advantage category in a number of ways. There are high barriers to entry, owing to the working capital requirements of aging. There's sticky, and in some cases captive distribution, very low private label penetration, and high legal and regulatory complexity. These structural advantages result in spirits being high-margin, cash-generative businesses dominated by strong brands with high private market values. When spirits businesses are sold, they typically change hands at very high multiples well in excess of where Diageo, the global leader, is trading today. So what did we learn at this week's investor meeting? First, that the new management team is focusing on leveraging the company's brands around the world, particularly its tequila and scotch brands. We agree with the thesis that there is a massive opportunity to expand tequila, a product that's historically been sold in the US and Mexico, to new markets. And with increased availability of agave, tequila's key raw material, Diageo is well positioned to lead that charge. We're also excited about the opportunity in India, an alcohol market where whiskey dominates. The demographic trends are highly favorable, and Scotch is set up for success. Second, we think that in their most important market, the US, Diageo has been hamstrung by a lack of supply in several key brands, and that they're now entering a period where it can leverage its scale with the distributors to get more fully back on shelf and lean into partnerships and promotion to regain lost share. Finally, we believe that by the numbers, Diageo's new growth framework gives them a lot of flexibility to invest in the business to drive growth. As a company with a core competency in marketing that already invests nearly 18% of its revenue in advertising and promotion, we'd expect incremental spending will be used to more aggressively grow share with promotions or build new brand strength in new places. Overall, we remain confident in the fundamentals of the business and believe that shares, which are trading at a significant discount to our estimate of PMV, are attractive.